In the last 24 hours, Wall Street lost its mind. One tiny chip stock ripped 43% before dinner, then crashed 18% the next morning. A pizza chain suddenly became a buyout target. A design app crushed earnings so hard analysts had to rewrite their models overnight. And a president flew halfway across the planet only to be told no. This wasn't a normal trading day. This was a riot in a tuxedo, and the tape barely had time to catch its breath. Friday, May 15, 2026. The Dow opened red. The S&P sagged. Treasury yields jumped. Inflation fears crept back in. And just hours earlier, Jerome Powell quietly wrapped his final stretch as Fed chair. On any other day, that headline alone would lead the news cycle. But not today. Today, individual stocks were moving so violently the index almost didn't matter. The action was happening name by name, ticker by ticker, headline by headline. Start with the biggest mover. Microsoft jumped roughly 9% in a single session. The reason was sitting on every analyst's desk in Manhattan. Wedbush analyst Dan Ives lifted his price target to $575, implying about 42% upside from current levels. Why? Because Microsoft just rewrote its entire relationship with OpenAI. The new deal caps OpenAI's revenue payments at $38 billion and pulls forward roughly $6 billion in cash to Microsoft this calendar year alone. Read that again. $6 billion in 2026 instead of $4 billion. That isn't a small revision. That is a 50% acceleration in cash flow on top of a deal Microsoft was already winning. Microsoft also locked in intellectual property rights to OpenAI's models and products through 2032, no matter when AGI gets officially declared. Translation: the company just removed the single biggest open-ended risk hanging over its entire artificial intelligence story. Then Figma exploded. The design software company priced its IPO last year and has been a battleground stock ever since. Bears insisted AI tools would eat its lunch within 18 months. Bulls argued it was the next great creative platform. Last night, Figma finally answered the argument with hard numbers. Q1 revenue grew 46% year-over-year to $333 million. Earnings of 10 cents per share beat estimates of 6 cents by more than 60%. The number that made the room gasp was net dollar retention. 139%. The highest figure in over 2 years. Translation: existing customers are spending nearly 40% more than they were a year ago. Figma also raised full-year revenue guidance to $1.42 billion at the midpoint, implying roughly 35% growth. In pre-market trading, the stock ripped nearly 13% before settling up about 9% into the close. The narrative shift here is enormous. For 2 straight years, AI was supposed to crush vertical software. Cursor would kill code editors. Vibe coding would kill product designers. Figma was supposed to be roadkill on the highway. Instead, the company reported its strongest seat expansion in years and explicitly called out early AI product monetization as a real, growing revenue line. The bear case on creative software just took a brutal, public haymaker on national earnings television. Now the wild one. Poet Technologies. Ticker Poet. A name most people watching this video have never typed into a brokerage app. On Thursday it ripped 43% in a single session. By Friday afternoon it was down more than 18%. 2 of the most violent single-day moves of the entire year, back-to-back, on the same exact stock. What actually happened? One contract, one customer, one piece of paper that changed everything overnight. Poet announced a supply and development partnership with a company called Lumolens for high-volume AI optical networking hardware. The initial purchase order is $50 million. The broader framework around it could exceed $500 million over the next 5 years. For a company Poet's size, that is a generational, company-defining deal. The stock had already climbed more than 330% year-to-date. Then this contract hit the wire, and the rocket lit again. So why the Friday crash? Read the fine print of the same press release. Tied to the deal, Poet issued warrants for up to 22.9 million common shares, exercisable at $8.25 over the next 9 years. That is real, future shareholder dilution. Q1 also revealed a net loss for the quarter. Retail traders chasing the headline number ran straight into institutional sellers reading the footnotes. Lesson learned: every blockbuster contract comes with paperwork. Meanwhile, the biggest stock on planet Earth was also the most political. Nvidia. The setup looked perfect. President Trump flew to Beijing for a high-stakes summit with Xi Jinping. CEO Jensen Huang was added to the delegation at the last minute, reportedly boarding Air Force One during a refueling stop in Alaska. Reuters reported Washington had cleared H200 chip sales to roughly 10 Chinese giants including Alibaba, Tencent, ByteDance, and JD.com. Traders smelled an imminent deal. Then came the twist nobody priced in. After the summit ended, Trump told reporters that Beijing was actually refusing to let Chinese companies buy the H200 at all. His exact characterization: China chose not to approve the purchases because they want to develop their own domestic chips. Not a single H200 has shipped to any approved buyer. Rare earth exports from China are still running about 50% below pre-restriction levels. The proposed AI governance framework? Zero signed documents. The market did what the market always does. Nvidia stock dropped. Not because demand vanished, but because the cleanest bull narrative in tech just got publicly muddied on live television. For months, the China reopening trade was supposed to be the next big kicker for AI infrastructure earnings. Now the question is far harder. If Chinese firms genuinely prefer domestic chips from Huawei and others, the H200 China revenue line might be a much smaller number than Wall Street modeled. From silicon to pepperoni. Papa John's, ticker PZZA, was the most unlikely star of the entire late tape. Investment firm Earth Capital, already a top 5 holder with roughly a 10% stake, formally offered $47 per share to take the company private. Thursday's closing price was $32.72. That offer represents a 44% premium for shareholders sitting in the stock that morning. Predictably, the share price ripped overnight as the news flooded headlines. The kicker is the franchisee angle, and it matters. Nadeem Bajwa, who once delivered Papa John's pizzas as a college student, now operates nearly 300 Papa John's locations, around 10% of the entire U.S. system. He is joining the Earth bid with a significant personal investment. This is no longer an outside raider knocking on the door. This is the operating backbone of the chain saying, out loud, we want to run this thing privately, away from quarterly earnings noise. Before you front-run it, breathe. The company is still formally reviewing the offer. There is, in management's own carefully worded language, no assurance any deal actually closes. This is Earth's second attempt. The first try last year, alongside Apollo Global Management, did not get there. 44% premiums sound generous on paper, but pizza is a cyclical, commoditized, brand-driven business with sluggish same-store sales numbers. Sometimes the offered price is the easy part of the whole transaction. Step back for a second. All of this happened on a day when the broader market was actually weak. The Dow fell on inflation concerns. 10-year yields climbed sharply, draining liquidity from growth stocks. The S&P closed deep in the red zone. But under the index hood, the dispersion was absolutely insane. Microsoft up 9. Figma up 9. Poet down 18 after up 43. Nvidia red on geopolitics. Papa John's higher on buyout chatter. Pure dispersion theater. That kind of dispersion tells you something real. We are not in a market driven by one neat macro story anymore. We are in a market where every single name has its own catalyst, its own countertrade, its own narrative war happening in real time. Passive indexing still works long term. But the actual money this week was made by anyone who sat at the desk and traded the headlines, name by name, hour by hour, footnote by footnote. 3 clear patterns to remember from this 24-hour stretch. 1. Big AI deals are now cash flow deals, not press release deals. Microsoft just proved it. 2. Small cap AI infrastructure stocks can double in a day and then have the next, so size your positions like a sane adult, not a meme account. Poet just proved it. 3. Software companies that ship real, monetized AI features can absolutely beat the AI disruption narrative. Figma just proved that one too. And the warning that ties it all together. China. Tariffs. Powell stepping down from the federal yields ticking back up again. The exact same macro forces that made today's gainers possible are the forces that could quietly create next week's losers. The Microsoft bull case rides on OpenAI execution. The Figma bull case rides on continued seek growth and AI uptake. The Nvidia bull case rides on a US-China thawing that just very publicly refused to thaw. So here is the question I want you to drop straight into the comments below. If you could only have one of these trades on your screen this Friday, which one would you have actually taken? Microsoft for the safety play, Figma for the breakout, Poet for the lottery ticket, Nvidia for the contrarian buy, or Papa John's for the buyout pop? Tell me your pick, tell me exactly why, and we will see who called it before the next bell rings. If this video brought you value, hit like, subscribe, and share it with a friend. Thanks for watching, see you in the next one.